Ever dreamt of getting rich quick? Or maybe you prefer the slow and steady path to building wealth? In the world of investing, these two approaches are called day trading and long-term investment. Day trading is like a fast-paced sprint, buying and selling assets within a single day to capitalize on small price fluctuations. Long-term investing, on the other hand, is a marathon, holding on to investments for years, riding out market ups and downs to reap long-term rewards. Day trading is all about speed and frequent trades. Day traders aim to profit from short-term market movements, often using leverage and complex strategies. They live and breathe market data, constantly monitoring charts and news to make quick decisions. Long-term investment is about patience and trust in the market's upward trajectory over time. Long-term investors focus on companies with strong fundamentals and growth potential, holding their investments for years, often decades. They believe that time in the market is more important than timing the market. Day trading offers the allure of quick profits, drawing in those who are eager to capitalize on market movements within minutes or hours. Successful day traders can generate significant returns in a short period, often seeing substantial gains that can be quite rewarding. It also provides a high level of market engagement, appealing to those who thrive on adrenaline and constant action. The fast-paced environment can be exhilarating, but it also comes with high risks and the need for quick decision-making. Long-term investment offers stability and compounding returns, making it an attractive option for those who prefer a more measured approach to wealth building. By holding investments for long periods, investors benefit from the power of compounding, where their returns generate even more returns over time. This method leverages patience and consistency, allowing wealth to grow steadily. It also requires less time and effort compared to day trading, as investors don't need to constantly monitor the market. This approach can lead to a more balanced lifestyle, providing peace of mind and the freedom to focus on other pursuits while their investments grow. Section 4 risks high stakes versus market volatility. Day trading is inherently risky. The allure of quick profits can be tempting, but the reality is far more complex. The constant buying and selling can lead to significant losses, especially for inexperienced traders. The market's rapid movements can be unforgiving, turning potential gains into substantial losses in a matter of seconds. It's also emotionally demanding, requiring strong discipline and risk tolerance. Traders must be able to manage their emotions, stay focused, and stick to their strategies even when the market is volatile. Long-term investment is not without risks either. While it may seem safer, it requires patience and a long-term perspective. Market volatility can cause short-term fluctuations in portfolio value, testing the patience of even the most seasoned investors. These fluctuations can be nerve-wracking, but they are a normal part of the market cycle. However, by investing for the long haul, investors can ride out these short-term dips and benefit from the overall upward trend of the market. Over time, the market has historically shown growth, rewarding those who stay committed to their investment strategies. Section 5. Trading Titans and Investing Legends. In this section, we delve into the lives and strategies of some of the most influential figures in the world of trading and investing. One of the most famous day traders is Paul Tudor Jones, known for his macro trades and ability to predict market crashes. His foresight during the 1987 market crash, where he tripled his capital, is legendary. Jones's approach combines technical analysis with a deep understanding of market psychology. Another example is George Soros, who famously broke the Bank of England by shorting the British pound. This bold move earned him over $1 billion in a single day. Soros' strategy often involves identifying economic imbalances and exploiting them, making him a master of currency speculation. In the world of long-term investing, Warren Buffett is a household name. Known as the Oracle of Omaha, Buffett's value investing approach focuses on buying undervalued companies with strong fundamentals. His philosophy of patience and discipline has made him one of the wealthiest individuals in the world. His value investing approach and long-term focus have made him one of the wealthiest individuals in the world. Buffett's annual letters to shareholders are considered must-reads for anyone interested in investing. Another legend is Peter Lynch, known for his impressive track record as the manager of the Magellan Fund. Lynch's investment philosophy, invest in what you know, encouraged everyday investors to look for opportunities in their daily lives. Under his management, the Magellan Fund averaged an annual return of 29%, making it one of the best performing mutual funds of all time. Section 6. Which strategy is right for you? So, which strategy is better? The answer depends on your individual circumstances, risk tolerance and financial goals. Day trading is suitable for those with a high-risk appetite, ample time to dedicate to trading, and a deep understanding of technical analysis. Long-term investment is more appropriate for most investors, especially those with a long-term horizon, a preference for passive investing, and a belief in the power of compounding. Section 7. Level up your investing game with InvestIQ. Want to learn more about investing and find the strategy that's right for you? Subscribe to InvestIQ, your one-stop shop for all things investing. We provide expert insights, market analysis, and personalized investment advice to help you achieve your financial goals. Don't wait, join InvestIQ today and start building your wealth.